Okay, well, welcome everybody. Thank you for coming. We're excited to have Robert Spendlove here. He is going to be talking to us about what's happening in our world right now. And do you want me to do the intro, Johnny?
Yeah, sure.
Okay, so we've got a lot of agents across the state who are joining us. Thank you very much. So Robert, he is a House of Representatives member. He's also so much more than that. He is Senior Vice President and the Economic and Public Policy Officer for Zions Bank. In this capacity, he monitors and reports on economic indicators and public policy developments for the bank. Founded in 1873, Zions Bank is Utah's oldest financial institution, and it operates locations in communities throughout the Intermountain West.
So basically a better looking version of Warren Buffett is who our guest
There
is.
we go.
A lot more.
Well, welcome, Robert. Yeah, I appreciate you being on, man. Your resume just, I learned a lot about you, the last couple of weeks since we've had this book, but even just this morning, like it is crazy, just like the positions and the committees and all the different things that you've served. You really have dedicated your life since your economic degree and your MPA just at the University of Utah. You've spent 20 years just totally submersed in numbers and statistics and research and all the economic policy that goes around that. So I just, we'd love just to get you talking and just pour out some of that wisdom that you've got. So we'd love to just jump in and get rocking. So.
Well, great. Thanks, Johnny and Emily. It's great to be with you today. We're just saying this is historic times. We've gone from the best economy in a generation to what is arguably the worst economy that we'll see in our lives, and it's still so early in the process that we're just now starting to get a better grasp about what's happening.
Great. Well, I'm sure we'll have a lot of questions and anybody that's on. So we are live streaming this as well to our Facebook page where the majority of our people jump on. So we'll just make sure that we're monitoring chat. Any questions that pop up, we'll kind of lob to you as you go through your presentation. But love to just, hear kind of your perspective and see some of the data that you've collected. So
make sure that as he's going through the slides, he definitely wants us to be interactive and be able to chat through. So make sure that you're posting your questions and we'll make sure that they're being answered as well.
Great.
Do you want me to start now?
Yeah, let's jump into the data.
Okay, I'm just going to do this.
And FYI, I love stats. So this is, if even nobody was paying attention, this would probably be one of my favorite interviews ever. So
Thank you. And can you see that?
Yep.
Okay, so let's just, wait a minute. Okay, so it's really interesting. We've seen a lot of changes in our unemployment. A lot of it's really unprecedented. That to compare it to what we've seen, you really have to go back to the 1918 flu pandemic, and we're still, even though it feels like it's been a long time, we're still in the early stages of what is happening in the current economic situation. So, and you'll see that a little bit in the data, and I'll talk about that. So specifically, what are we seeing? What economic data are we seeing because of the coronavirus? So going into this, we were in one of the strongest equity markets in history. We're seeing all-time highs in Dow Jones Industrial Average. 2018 was kind of a slow year, kind of a flat year. But 2019 had been a very strong year leading into this. And you're going to see this theme quite a bit with a lot of the data. What have we seen since it started? Stock market has dropped significantly. Passing the period, so you can see a correction is a 10% drop in equity markets. We saw more than 20% drop. So entering us into a bear market. Now we've recovered a little bit since then, and the Dow Jones is back up above about 24,000 right now, and today it's looking pretty good too. But we're still there's still a long ways to go, and we're still there's still a lot of risk that is in the markets today. Oops. So why is this happening? One of the areas that we're seeing this is this economic uncertainty. So this is looking back, this is a survey conducted by the Wall Street Journal. The last time we saw this kind of uncertainty was in the Great Recession. And we've actually passed that just in some of the early indicators. And so we're seeing a high level of uncertainty. Optimism, this is the NFIB Small Business Optimism Index. You can see, and I don't know if you can see can you see the pointer on here?
Yep, you can.
So we saw a big jump after the 2016 election. As business optimism went up, people felt really good about where the economy was going. So we saw a jump in business optimism, held at that level for the next several years. But again, you can see how much that has dropped just in the last couple months, where we've dropped, that business optimism has dropped from about 105 down to about 95. So we're starting to see some of those impacts because of the results of the dramatic changes from shutting down businesses throughout the economy. Consumer optimism. This is the conference board that collects this. This data just came out last week. It's the largest drop in consumer confidence since Watergate. So we've seen a big drop. Again, leading into it, you can see 110, that green line indicates a prosperous economy. And it was showing that the economy was doing really well, and consumers were feeling really good leading into the current downturn. But then we have seen a big drop in that consumer confidence just in the last month as consumers start to change. Now, one that I didn't include is this is consumer confidence in the current economic situation. But if you look at consumer confidence in the future, it's consumers feel like 6 months to a year from now, conditions will be improving. And that's a good sign because, as they say, so goes the consumer, so goes the entire economy. But what are we seeing? The consumers' attitudes turn into consumer spending. And we've seen big drop in retail sales, over 9% drop in consumer sales just in the last month. And then when we can compare it to a year ago, it's down about 6%. Now, again, a lot of that is being forced by government shutdowns and by people being essentially forced to shelter in place. But even as things start to reopen, there still seems to be reluctance from consumers to get out and start spending. There's still reluctance to go to restaurants, reluctance to go to movie theaters, or and of course sports is still shut down. So we're still seeing those impacts. What about the labor market? So this is a tough one because we are going to be seeing on a monthly basis, the Labor Department releases their jobs report, and it's released on the first Friday of every month. So the new report will be released this Friday. And this is just kind of an early indicator of what we're going to see on Friday. But the big story, and it's probably going to be the biggest economic report we've ever seen, because this was just taking in a few weeks of the impact of the coronavirus. So we saw 700,000 jobs lost in the economy. Unemployment rate jumped up to 4.4%, and our labor force participation dropped. So that's the top line numbers. What does that mean in context? So if you look back to 2009, that's the Great Recession. During the Great Recession, we were losing about 700,000 jobs a month for about 6 months. We have now re-entered another period of dramatic job losses in our country. Now, but if you look at kind of the curve of this drop, it generally, and this is what is so unique about the current economic situation, is it usually takes months or years for an economy to kind of lose steam and hit the climax of a recession. or what we call as the trough. This is what we call a trough at the bottom. What usually happens in months or years, in this case, has happened in weeks. So we are seeing a dramatic impact over a period of weeks. And that's one of the struggles, is the economic data is struggling to keep up with what's actually happening on the ground. But coming out of the recession was, so the big debate, this is what you would call kind of a V-shaped recovery. The big debate right now is, will the recovery be V-shaped, where we come back out quickly, or is it going to be more of a U-shaped, where it takes a longer period of time to move out of that? And again, this is just the very early indication. Friday, I expect the numbers will be dramatically higher than what we saw. That 700,000, it very well could be 7 to 10 to 15 million jobs lost in the economy. And you can see that just comparing the last few years, we were seeing average growth of about 200,000 a month, and then dropping by 700,000 in March.
And mention this, Robert. Yeah, because obviously unemployment is a hot topic, right? Like, and every report I read, one's positive, one's super negative, one's positive, one's super negative. They keep referencing peak unemployment being anywhere from, like, I think JP Morgan has it like at 8.5% peak unemployment, but then some of the more pessimistic, like St. Louis Fed, has it at like 32% peak unemployment. Like, are you tracking that pretty religiously, and do you have an opinion on maybe what we might end up at?
Yeah, and that's one of the big questions. The head of the St. Louis Fed, so this isn't a crazy out there estimate, but the head of the St. Louis Fed said we could see unemployment as high as 25%. Now, to put that in perspective, in the worst part of the Great Depression, unemployment was right at just under 25%. I think for April, when we see that data on Friday, I expect to see that number be at around 16%.
Wow.
So, and to put that in perspective, the Great Recession, we topped out at 10% nationally. In the 1983 recession, we topped out around 12%. So, we're going to, and again, you have to look at that buildup. It took months to get there. And we're going to be, I wouldn't be surprised to see unemployment closer to 20%. I think the kind of conservative estimate is probably about 16%, but we could see it as high as 20%. If you look at, and let me just jump to there real quick. If you look at our unemployment insurance claims, so this is kind of the early indicator of what we expect. So there's the monthly report, which is what I've been talking from, but there's also weekly reports of unemployment insurance claims. And it's not a great indicator, but it gives you kind of a sense of the direction. Just last week alone, we had 3.4 million people file for unemployment insurance. And when you look at the total over the last 6 weeks is 30 million people in the US have filed for unemployment insurance. Now, the reason that's a bad indicator, though, is people go on and people come back off. The ongoing, so people that have weekly filed for unemployment insurance is about 18 million. And that 18 million would point to, if you just took that 30 million total, that would point to an unemployment rate of 25% already. But if you look at the ongoing, which is about 18 million, that would point to an unemployment rate closer to that 15%. So that's kind of why I'm looking there. In Utah, and I think I have so Utah specifically, we've seen about 150,000 people file for unemployment insurance.
So how does that compare, Robert? So if we're looking at percentages, because I think that's part of the confusion with all this, is how we take the national news and we break it down to what's really happening in our area. So when we're talking about unemployment claims, how does the percentage of that compare to what's happening nationally? Is it right on par with what's happening nationally? Is it lower? Is it higher?
Yeah, that's a great question. So, and again, that 150,000 is kind of overstating the true unemployment in the state. I estimate that Utah's unemployment, and I'll get to this specifically in just a minute. I think right now Utah's unemployment is around, if you were to actually see the number of people who don't have a job today in Utah, I think it's around 5%, moving towards potentially 7 or 8%. And it is having a huge impact. But as businesses start to reopen, as we start to see the impact of the PPP grants, we're hoping that we're going to be able to shave that off very quickly. One of the other areas that is going to be troubling too, this is where it's going to be really hard to really know what's happening. So here's the top line unemployment. This is the number you always hear about. But underemployment, so that green line, takes into effect discouraged workers. This is people who have left the labor force but would still like to have a job if one existed. It also takes into effect people who are working part-time but would like to be working full-time. I think we're going to see a big jump in that underemployment. In fact, I think underemployment will become a better measure of the labor force than unemployment, because you're going to have people that would like to be back to what they were doing before, but those resources just don't exist. And then the third one is what we call labor force participation. And this is saying, of the total population, how many of those people have a job or are looking for a job? And what I think we're going to find is that unemployment rate, that top line unemployment rate, won't be as high as it would have been otherwise, because people are just going to start, a lot of people will leave the labor force entirely. They'll say there's no options, there's no places for me to work, so I'm not even going to bother applying and looking for a job. So so I'm going to be watching to see how much that labor force participation rate drops in the next report and in the next few months. You can see we already saw a big drop in labor force participation last month. We will see that drop to maybe the lowest level we've seen in a generation on Friday.
Let me ask you this. It was a great question that was posed on our chat. Are we comparing apples to apples just due to the fact that some of the expanded CARES Act or the unemployment benefits now include potential independent contractors or maybe some freelance work? You know, our entire realtor population is all 1099. Like, how does that it play into the unemployment numbers?
Yeah, so it does include independent contractors in the calculation and also in the PPP loans. But the nature of work is so different that they are generally not included in the U6, or that, let me show you that underemployment rate. And so and again, this is another one of those problems of the economic data sometimes has trouble really keeping up with what's actually happening on the ground. And so you may be working, but the amount of work that you're doing is much lower than it was in the past. And so that's where we will continue to struggle to be able to really understand especially on the short term, the real impact of this. We all know anecdotally that the impact of this is so much more dramatic than the data that we're seeing. But this is, like I said, this is something that we will be studying for generations, how this happened and what the reaction was and how the economy responds. And so in a lot of ways, we're still in kind of that fog of war, trying to figure out what's going on and what to do next. And I'll tell you, from a public policy perspective, the government has made mistakes already and will make more mistakes. And we're going to have to say, okay, how do we learn from those mistakes and try to do better as we move forward? Looking at, and this is one of the areas where the data isn't showing accurately what's happening. Our wage growth for the month of March still shows at about 3%. I don't think that's accurately showing. I think we're going to start to see, this may take a couple months to start to see that wage growth dropping, but at least for the latest data, it was still relatively strong at 3%. But look at this, manufacturing activity. This is a survey that comes from the Institute of Supply Management. We see the dramatic drop below 50 shows that the industry is contracting. We dropped all the way down to 41.5%. So you can see that we're entering similar territory to what we saw in the Great Recession. And I'll skip over these. They're pretty much everyone who responded cited the coronavirus as having dramatic impacts on manufacturing. So the broadest measure of the economy is GDP, gross domestic product. Now, GDP had been holding up really strongly over the last few years, but then dropped 4.8% in the first quarter. Now, the reason that this one is so impactful, GDP is the first 3 months. So the first quarter is the first 3 months of this year, right? January, February, and March. We didn't really start to see impacts of the coronavirus on the economy until March. And so this is essentially all the gains in January and February were wiped out in the month of March. And again, this is one of those early indicators of how bad it could get. There are some estimates, some forecasts that the economy could contract by 30 or 40% in the second quarter, the quarter we're in right now, once we start to see the full effect of the downturn. But this is just an early indicator, but it also does show that we are officially entering a recession. Now, a recession is technically defined as 2 consecutive quarters of negative GDP growth. So we've got the first quarter, and we all know the second quarter is going to be negative. So we have entered a recession. The only question is how dramatic that fall will be and how dramatic that recession will be. Now, if you look at the components, the 2 biggest parts of the economy is business spending and consumer spending. And consumer spending is the blue area. The consumer is the single largest contributor to the economy. And we saw, so if the consumer continues to spend, the economy will continue to grow. And you can see that where the blue, the dark blue, in all these quarters continue to be positive until the first quarter. You really see that in the next one. So this is comparing that business spending to consumer spending. Even a few quarters ago, last year, business spending was starting to drop off, but the consumer held strong and the economy continued to grow. But then in the first quarter, we saw both business spending and consumer spending drop dramatically and pulled the economy into recession. So what's the response? The response has been, so with an unprecedented economic impact, we have seen an unprecedented response from the government. We've seen the CARES Act is actually the 3rd bill that was passed by Congress, but it's also by far the largest economic stimulus our country has ever seen. Just the first round was over $2 trillion. We're now upwards of $3 trillion of federal spending to help stimulate the economy. To put that in perspective, during the Great Recession, the federal stimulus was about $800 billion. So we are dwarfing the stimulus and the federal actions to respond to the virus.
Do you think it's going to take more than that?
What?
I've
Yes.
heard numbers of
Yes.
6 trillion even out there.
Yeah, it will. If you think about the PPP program, it is funding 8 weeks of payroll, and it's going to take a lot more than that. It's either we need to, and this is, I'll tell you, this is the big debate right now. there's a debate between protecting the public and protecting the economy. And unless we just reopen everything and restart everything right now, we will continue to have to support the economy. And even if we do, even if we were somehow to wave a magic wand and reopen everything, then we have the problem of the healthcare system struggling. And so it really is a tough issue. But yeah, we will continue to need more federal stimulus. Now, there's two sides of it. There's fiscal policy and there's monetary policy. The CARES Act is fiscal policy, but the Fed has also taken unprecedented action in monetary policy. I want to get into that just a little bit too. So the Fed cut interest rates. The Fed only really controls one rate. They call it the federal funds rate. They cut that rate from 2.5% all the way to 0 in a period of weeks. They got as aggressive as they can on interest rates leading into this. Now, here's the problem. In past economic downturns, the Fed has been able to cut interest rates by much more. So remember, we cut it from 2.5 down to 0. In the past, they've had to cut it by 5% or even 7% to have a similar impact. But the problem was the Fed wasn't able to get interest rates up high enough leading into the recession to be able to fully use that tool. So that's one of the struggles that the Fed has, is they haven't been able to use interest rates the way that they have in the past. So the other thing the Fed has done, they call it bond buying. So the Fed literally goes out and buys bonds and securities. So it's their way of just, Ben Bernanke, the former chair of the Fed, used to say, if we have to, we'll go up in the air with a helicopter and drop money. And that's really, in fact, people used to call him Helicopter Ben. And that's really what we're seeing. I mean, if you look at it, whether it's the PPP fund, whether it's the individual checks, whether it's unemployment or the Fed buying bonds, they are just throwing money at this in any way they can. So just to put in perspective, before the Great Recession, the Fed's balance sheet was about $800 billion. They increased it all the way up to about $4.3 trillion after the Great Recession. And then they were trying to sell that back off. The Fed had said, okay, we're going to try to bring that balance back down, have less debt. And then we were hit by the coronavirus. And you can see how that has just skyrocketed. Here's that 6 trillion you were talking about, Johnny. The Fed's balance sheet has just skyrocketed up to 6 trillion. The current chair of the Fed has said, Jerome Powell has said, we will do whatever it takes to support the economy.
So how does that, sorry.
Yeah, go.
So we started to talk about this a little bit before the call. I've heard people talk about, how does that just printing of money and giving money away, how does that in itself not kill our economy?
No, that's a great question.
Explain how that stimulates?
Yep. And that's a really good question. And I'll tell you, the debt of our federal government is a concern. We were approaching the highest debt levels on record post-war, before the coronavirus hit, and we're now approaching World War II levels of federal debt. And now the reason that's a problem is, and this is one of the big concerns of monetary policy, is the more money you have in an economy, it essentially starts to cause inflation. And you see that in some countries like Venezuela or Argentina, where they'll have hyperinflation. And that's one of the big fears, is the more money you have in the system, the less each dollar is worth. And so the big fear would be a big increase in inflation. And that was actually a great question, Emily, because my next slide is that inflation. And we're actually seeing the opposite happening. That we're seeing inflation dropping. The overall economic forces are even greater than the Fed's ability to, and the government's ability to spend money. So inflation, and Jerome Powell addressed this last week. The Fed met and someone asked him that very question. And he said, at least right now, inflation is not a fear. The big fear right now is deflation. In fact, if you look back to the Great Recession, it was deflation that had the biggest impact on the economy. And that's what we're trying to prevent. As bad as inflation can be, the worst thing that can happen to an economy is to have deflation. In other words, as time progresses, the value of everything goes down. And that can really stall up and cause severe problems in an economy. And so that's what that's the real fear of the Fed right now, is deflation. Now, how are we seeing signs of that? If you've been watching energy markets, 4 years ago, oil prices were close to $100 a barrel. Coming into this year, they had dropped down to around $50 to $60 a barrel, and it held steady in that level for a long time. So we're at a good place, about $50 a barrel. It keeps gas prices down, but it also is profitable for oil producers. Then we come into April, and if you were watching, for the first time ever, futures contracts for oil dropped below zero, and they actually went all the way down to negative $35 a barrel. Now, what that says, that the sign of that is just that the oil market is completely broken. Now, and I don't want to get too much into the technicalities of it, but it's essentially saying it was a futures contract for purchase of oil in May that was done in April. Now, oil prices have recovered and come back up again, but we're still seeing a lot of weakness in the oil markets. Why is that? So if you go back to your basic economics, there's supply and demand, right? We've seen demand of oil drop dramatically. Airlines are closed. No one's traveling anymore. The shipping is way down. Supply chains are closing down. So there's a much reduced demand for oil, but the supply was too high. We had a battle between Saudi Arabia and Russia, and they were keeping the supply of oil way too high for way too long. And so you had that complete breakdown of oil markets, which pushed those oil prices below zero for the first time ever. What are we seeing now? So this is looking at the price of oil in green and total U.S. oil rigs. So oil rigs is the best way you can measure the supply. The green is demand, and the blue is supply. And we are seeing a big drop. We're finally starting to see a big drop in oil supply. We're seeing a contraction in that oil production. And so we expect that those prices will start to level out a little bit more. But it's going to mean a lot of pain in the oil producing areas of our state and our country. And we're already starting to see that quite a bit up in the Uinta Basin.
Let me ask you this. So you obviously are going to get into housing a little bit, but I want to connect the dots on that, because obviously if GDP, which is basically like the revenue of companies out there, decreases because, consumer confidence down, there's more unemployed people, there's just less people that want to buy those products, that sometimes these companies' solutions is, well, maybe we'll just charge a little less for that new pickup truck just to like motivate people to bring in the sales, which is similar to the real estate market, right? Like if there's more inventory out there than demand, it halts the price increase. The question that we get a lot, obviously we understand the GDP, we understand the unemployment, but how is this going to affect home values, right? Like, are we going to actually see the value of a home decrease? Is it going to stay flat? Is it going to increase? And that all just starts if inventory really pops up a bunch, that your neighbor all of a sudden says, you know what, I'll take $5,000 less just to get this thing sold. And then the next neighbor does it, and the next neighbor does it. And then before you know it, we've deflated the value of homes.
Yep.
Do you feel like, and you might be getting into some of this stuff, but do you feel like this is going to have a quick effect on the value of homes, just what's going on?
Yeah. And let me jump back real quick, because what you're describing is right here. That's what happened during the Great Recession. This deflation was caused by the collapse of the housing market and of the real estate market. It was that dramatic drop that caused that deflation that made the economy so bad. So that is one of my biggest concerns. How real estate is one of the most important areas of the economy, and if we see a repeat of that, it could make things even tougher. However, I do believe that the circumstances that existed in the Great Recession do not exist today. I think we're fundamentally different. We don't have the same kind of weakness that we had leading into the Great Recession. But there is still some pain. So number one, because the Fed cutting those interest rates, mortgage rates are hovering right around 4%, all-time lows in mortgage rates. So it's still a good time to finance a new home or refinance a house. But we have seen, this is national data, new home sales are declining. Anecdotally, talking to builders, I've heard anywhere from kind of in this range, this drops of around 20% in new orders. And so we are seeing that, especially on the new home side. And we'll continue to see some of that downward pressure on the demand for new homes. The growth in values is also starting to come down a little bit. Now, if you look, it's still positive. It's still growth of about 3%. And I would argue that the growth we were seeing previous was probably a little bit too high. So it's good to see some of that house price appreciation coming down from where it was before. And then specifically looking in Utah, now you can see a big drop. I mean, Nevada is all boom and bust. They've gone from a boom in 2018 and they're already dropping way down. In Utah, we were right around 10% growth. We're now about 5% growth. And I think we'll stay in that level for the next little while. And the reason for that is inventories. We continue to see really strong population growth, and we're not building fast enough to keep up with that demand. And so, and again, just anecdotally, I continue to see housing moving quickly in some areas. I have some friends that are looking to move, and they're in a bidding war right now this week. And so we're not going to see the housing price appreciation that we've seen in the past, but I don't think we're going to see a big drop in overall demand for housing.
You know, that's actually one of my optimistic theories in general is, you know, if you even look at the affordability of the typical home in the state of Utah or across the country, like mortgage rates have came down enough, even though prices has continued to go up the last 2 years, but it's almost ruled each other out, and our affordability for the average price home, for the average, you know, income for a home, or household income is almost flatlined to some degree because they've offset each other. And that's one of my optimistic theories specifically about the Utah economy, just because our net migration has just been awesome, right? Like our demand has been awesome. Our inventory has been so low. The demand is high that, man, if we can just get past this thing, it's almost like we're going to get out of this somewhat positively almost. You know, I know there's a lot of industries very suffering, but I'm talking specifically about the real estate
housing.
Yeah, that's exactly right. And we and that's one of the things you always have to be careful. I remember Donald Rumsfeld talking about we're always fighting the last war, and we're always thinking about the last recession. And the last recession was a housing recession, but I don't see that in this one. The banking problems that we had in the Great Recession aren't there anymore. We have the fundamental demand is still there for housing, and while we are going to see a slowdown, I don't see the kind of weakness that we saw in the last recession for this one. This one is really going to be the big impact on this one is going to be those service industries. It's going to be travel and tourism. It's going to be restaurants. It's going to be entertainment. Is really going to be the areas that struggle the most in this recession.
So let me ask you this with just along these specific lines. Real estate is an essential business. We're very lucky in Utah that we're still able to do that. If you worked, and you do work in, with Zions Bank, definitely a portion of the housing market. If you were a real estate agent, so you put yourself in our shoes of who we are, what is your message to people with all the information that you have? If you had all your clients in a room and you came out and you said, what is that message that you would give to your clients and your people based on the knowledge that you have?
I would say we need to be realistic about what's happening. We need to be realistic about the drops that we've seen and about where we're going. I don't think it's realistic to say that we will have a shallow recession and a quick recovery. I think it is going to be dramatic. I think it's going to be something we've seen, the worst we've seen in our lifetimes. And I think we need to be prepared for a new normal. But on the optimistic side, Warren Buffett said this over the weekend. He said, never bet against America. Never bet against the American economy. Never bet against the American consumer. We've been through things like this before. We've been through pandemics before. We've been through the Great Recession. We've been through the Great Depression. We've been through 9/11. And I am extremely confident that we will be able to address this. We'll be able to address the pandemic crisis and also the economic crisis. It's going to be tough, and we're going to be in this for a while. But I have always had confidence in America and Americans, and I will always be a long-term optimist.
Well, I've got a couple big big picture questions, but is there any more slides that you wanted to hurry and zip through before I ask them?
No, this is good. We can move, we can go from this. Let me just.
Well, yeah, part of it is even just like really like you have just, just filled with wisdom and just stats, and you're in all sorts of meetings and committees and all that sort of stuff. But even when it comes to like personal preparation, cutting personal and business expenses, doubling your work ethic, everybody's got to work a little harder, that type of thing. What other personal recommendations or even like personal wealth building tips could you see? Obviously the first things, be safe, survive, care about people that really are suffering, but like potential like thriving or even opportunities that can come out of a down market. You often hear that more wealth is transferred in a down market than in an up market. Do you have any potential, insights on that?
That is absolutely true. And sometimes it's tough to be an economist because you sound like you're crass, but recessions are essential to the health of the economy. They're essential to the long-term health of the economy. If you think of a forest, forest fires are essential to the long-term health of the overall forest. And if we don't have it, what do you have? You have the buildup of underbrush, and you have the buildup of noxious weeds, and every few years you need to have that cleanup. And there are opportunities to actually benefit from this. It's more difficult, over the last 10 years, it's been relatively easy to do relatively well. Now it's going to take some real time and effort and hard work to identify those opportunities, but they will exist. And watching those markets really closely, watching those opportunities for growth, someone can do really well. On a broader scale, this is kind of weird. So one of the things I'm always recommending that people do is save money. You should always be saving money. You should always be making sure that you have the ability to withstand a downturn. And I still recommend that today. But one of the best things we can do for the economy is you need to get out there and spend some money. Believe it or not, we're saving too much. Consumers need to get out there. We need to be shopping. We need to be going out to restaurants safely. We need to be going on vacation safely. We need to be ordering things and getting new clothes or getting a new washer. That's the best thing we can do for this economy. We don't want to just pull back into a cocoon and stop interacting. And so the sooner we can do that, the better it is for the economy.
Yeah, that's a great tip. Yeah, even the governor, I think he said, dine out at least 3 times a week or something like that, or get takeout the last few months. So I guess, I know that, you don't have a crystal ball by any means, but you'd mentioned the U, we had heard the V, theory before. We've even heard a W, like I'm afraid they're going to start throwing out X's and Z's, who knows? But do you really feel like the U is most likely the shape of how this can happen as we're going to continue to decline for the quarter 2? A lot of people are projecting, a very healthy quarter 3, just as hopefully we rebound a little bit. But when do you think we would be totally on the other side of this?
Totally on the other side, I think, oh gosh. I mean, the hard part is, I think we, in a lot of ways, we may be entering a new normal. We may never get back to how it was before. But in terms of when will we start to see the economy growing again, I think we could. I think it's accurate to say that we could be growing again in the third quarter. When will we be back to? If you just take jobs, when will we be back to the amount of jobs that we had in January? I think could be a long period. It could be 2 to 3 years. It takes some time to climb back out of that hole. So we may turn the corner in the third quarter and be done with the trough, but it'll take a while to kind of dig back out of where we were. And then the big unknown in all this is what happens with the virus. Do we have another wave in the fall? Right when we're starting to rebuild, do we get another big infection rate, and does government start shutting things down again? And that's, I think, if things remain how they are right now, we'll start turning around and we'll start seeing some benefits. But there's going to be a big question about what we see in the fall and how we react to it as well.
Right. So let me ask you, I got 2 more questions, and then we can wrap up unless Emily has more questions. But the first one is, like, I'm always such a proud Utah citizen. I always feel like we make a lot of better decisions than other states or even the federal government. How much, like, insulation or advantages do you feel like we have because of the health of Utah economy and the conservative nature of our population? Like, is that going to play into the positive effects that we'll see compared to the nation?
Yeah, I absolutely do think that. So professionally, this is my 3rd recession. So I I graduated from college in 1999 and started working in the governor's office as an economist, and went through the 02 recession and then the 09 recession. And so and what we saw in both of those recessions was, even though Utah did suffer in both of the past recessions of the last 20 years, in both of those recoveries, Utah came out as the strongest state in the country and the best growing economy in the country. And we are suffering, and even Utah is seeing job losses, and we're experiencing the greatest pain that we've ever seen in our economy. But I'm also really confident that the economic environment in Utah is such that when we start to come back out, Utah will be very well positioned for growth in the future.
Okay, that's fantastic. The last question I have is, I even open any of my news apps, like, it's just sometimes chaos out there and who you can turn to for the right advice. And this might be a loaded question, but if our agents or our people wanted to go to just a handful of resources that you feel like are very valuable at keeping us up to date on what's going on with, the economy locally and nationally, like what would maybe be some recommendations that people want to learn more?
Yeah, well, I guess the first one I'd say is Zions Bank. But when I'm getting economic data, I am very strict about my sources. I use I try to go to the original source, which is generally at the national level. It's the Labor Department, or it's the Bureau of Economic Analysis, or the Census Bureau. At the state level, the Department of Workforce Services, the Utah Tax Commission, the original sources. Now, the Association of Realtors is also a great source. That's where I get most of my real estate data. But also, and I think this is true beyond just economic data. You need to be really careful about where you're getting your news. And I only go to reputable sources, the Wall Street Journal, New York Times, CNBC, and then at the local level, I stick to the Deseret News and the Tribune and the actual sources, because in this kind of fog of war period, there's a lot of information coming out, and we're finding out that a lot of it is not accurate. So it's even more important now to make sure that your news is from a trusted source.
Well, Robert, I really appreciate you being on here. I felt like that 45 minutes zipped by pretty fast, but we would love to, connect with you and maybe just even schedule some future meetings. I really appreciate you being on today and sharing your thoughts. So
thanks. I'm happy to do it.
Really appreciate it.
And we'll be in contact with you to try to get your slides, because we've got a bunch of people asking for them. So love to share.
Yeah, I'm going to send them